Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. I'm John Ward on behalf of Physical Gold Fund, and we're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times bestselling author and the chief global strategist for West Shore Funds. He's the former general counsel of Long-Term Capital Management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. How are you?
Excellent, thanks. And yourself?
I'm doing fine, thank you. Beautiful day here.
Very good. And down here in Arizona, too. So, Jim, as we're recording this interview, we're just before the start of the September Federal Open Market Committee meeting, and you've consistently predicted no rise in interest rates, though I see that you remarked a few days ago that it's a closer call now than at any time this year. I'm interested in that close call remark. Is that because U.S. and global economic fundamentals have actually improved?
Well, it's interesting, John. I've been saying that there'll be no rate hike in all of 2015, and I said that in late 2014. I think some of the listeners may follow me on Twitter, and the great thing about doing television interviews is you have the video links. Actually, same thing with this podcast. We have all the audio links, so I can show some clips from late last year where I said that. But just to be clear, this is not guesswork. This is not just sort of staking out a position for the sake of attracting a little attention or being controversial. It's all based on fundamental economic analysis, and I don't even try to be that heterodox or orthogonal to what the Fed is saying. I actually listen to the Fed. I read the speeches, I read the minutes. I don't listen so much to television commentators, but I listen to the Fed itself and what the governors and Reserve Bank presidents are saying, and then take those indicators, combine it with actual data, and draw my conclusions. So I have been saying it all along. I think I did say, this one maybe is a little closer than usual, although I've actually backed away from that at this point. It's unfortunate that it changes day to day. I mean, again, I've consistently said that there'll be no rate hike. What's interesting about this time is, when I said last year that the Fed would not hike rates in all of 2015, I wasn't talking about a particular meeting. I said I didn't see how it could change over the course of the year. Of course, Wall Street was saying March. You all remember they were going to raise rates in March, and said the Fed just took away forward guidance, removed the word patient. Then everybody said June. We're all spun up about June because there was a press conference, and that didn't happen. And now everyone's saying September, and I still don't see it happening. And I expect that Thursday will come and go with no rate hike, and then we'll all be talking about December, although if there is a surprise on Thursday, the Fed might drop a hint about October. Just to digress on that a moment, there are 8 FOMC meetings per year. They don't meet every month. They meet eight times a year, but only 4 of them have press conferences. They don't always have a press conference, so the working assumption is, well, they would only raise rates when there's a press conference because they'll need that opportunity to explain their thinking to reporters. But actually, that's not true. Last spring, the Fed rehearsed an impromptu teleconference. They gave everyone, one of these dial-in numbers, kind of what we're doing right here, with where listeners can log in. And they said, don't assume it has to be at a press conference meeting. We might do it at one of the other meetings, and if so, we will do one of these webinars or teleconferences to explain ourselves. So don't rule that out. But be that as it may, I'm so used to being out of consensus that now it looks like a majority of the economists and an even larger majority of the major Wall Street economists, at least those associated with primary dealers, and the Fed Fund futures market, and all the indicators we can find are saying there's no rate hike this Thursday. So it always makes me a little bit uncomfortable when I'm in the consensus. It makes me wonder what I'm doing wrong. But be that as it may, it looks like Wall Street and the markets and others have caught up to the view that I've been presenting all along, which is that the economy is just too weak. And to bear a rate increase, as I've said before, the time to raise rates actually was 2010, 2011, when the economy was growing on a sustained basis. It wasn't growing strongly, nowhere near potential. Unemployment was still high, but it was at the early stages of a recovery, and that was the time to raise rates, and the Fed didn't do it. They missed a whole rate cycle, and now it's too late. Actually, right now, we're probably getting close to a recession. Certainly, the world is slowing down. You look around, you see China not technically in a recession, but slowing down dramatically. Brazil, Japan, others in technical recessions. Russia, other major economies in recessions. The U.S. slowing perceptibly. You're what I call the happy talk crowd. They like to look at second quarter GDP at 3.7%. That was pretty strong, although a lot of that was inventory accumulation. But there is a tool put out by the Federal Reserve Bank of Atlanta. It's a real-time GDP tracker. It's not perfect, but it's kind of the best information we have. And it's showing third quarter GDP. And of course, we're almost at the end of the third quarter. It ends on September 30th. We won't have that official number till the end of October. But here we are most of the way, almost 5/6 of the way through the third quarter, and that's indicating 1.5%. So combined 0.6 in the first quarter, 3.7 in the second quarter, 1.5 estimated in the third quarter. Put it all together, it looks like 1.9% growth from January to September, most of the year. In other words, the same kind of crummy 2% or less growth we've had all along since 2009. Certainly not a compelling case for raising rates. So that is my expectation. We'll all find out on Thursday. I would say that one of the things I do in my analysis is I have a view, and I'm not necessarily shy about expressing it, but I do ask myself, well, what if I'm wrong? What if they do raise rates? Notwithstanding my expectation that they won't. And that could actually be catastrophic. It's a good reason for investors to think now, actually should have been thinking all along, about probably increasing your cash position, and if you don't already have, let's say 10% gold, adding to your gold position, get into some of those safe harbor assets, because if the Fed raises rates, again, I don't expect it, but if they do, this is going to exacerbate what's already an emerging markets meltdown, massive capital outflows coming out of emerging markets, coming into the U.S., making the dollar stronger, and it could be very, very nasty sailing. I think we'll have, even if they don't raise rates, I do expect more of the same. When I say more of the same, the Fed will continue to talk tough. In other words, they'll talk about raising rates even though they don't raise them. So if they don't raise rates, but they continue to talk tough and even hint at October, which again would not surprise me, that's going to keep the dollar strong. It's going to keep the pressure on emerging markets. We'll have more of what we've been seeing since August, which is pressure on emerging markets, currencies, capital outflows, volatility in U.S. markets, concern about a global slowdown, and possibly the beginning of a bear market in equities. So I think all those things will continue. If they do raise rates, I would expect all that on steroids. That basically they would accelerate what could be a market panic comparable to 1997. What the Fed needs to do, and this is the thing I least expect, but what they need to do actually is ease a little bit, because as I say, we are in danger of tipping into a recession. Now people say, well, how can the Fed ease? Rates are at zero. They actually do have 5 tools in the toolkit. And I'll leave aside whether any of these things work. That's a separate discussion, but at least in the Fed's mind, they all work. And they could look at QE4. They could look at negative interest rates. That would be a bit of a shock in the U.S., but they could do that. They could resume the currency wars, try to cheapen the U.S. dollar, particularly against Europe and Japan. They could go back to forward guidance. That's just jawboning, but reintroduce the word patient. We're going to be very patient at this time, which they took away in March. Or they could use what's called helicopter money. Helicopter money is when they work with the Congress to run larger deficits, and the Treasury papers over the deficits with borrowing by issuing bonds, and the Fed buys the bonds. That's just another form of money printing. The difference between QE and helicopter money: when you do QE, you give the money to the banks. When you do helicopter money, you give the money directly to the people in the form of whatever programs Congress decides to support. So again, I'm not here to debate whether those are good ideas or bad ideas, but there are 5 ways for the Fed to ease or purport to ease, and I don't expect any of them, but if things get worse, which we may see those things early in 2016. So for now, I'll stand on the forecast, but of no rate increase on Thursday, maybe a hint of an October surprise, more volatility. But to your point, John, whatever closeness in the call I might have seen a couple of weeks ago, I think has disappeared, and actually the economic data since then has confirmed my long-held view that they will not raise rates.
Let me just ask you one twist on this question, Jim, because you're right that many more commentators seem to be lining up with your long-held forecast that they won't raise rates. But I'm seeing some voices saying, well, the fundamentals don't justify them raising rates But it's very dangerous if they don't, because then they'll be leaving it too late, and when they do eventually raise rates, it'll go too fast. Is there any validity in that anxiety? What's your view on that?
That doesn't fit the facts and doesn't fit the data, and here's what I mean by that. If they don't raise them now, they'll leave it too late. I would say it's already too late. The time to raise them, as I say, was 2010. Look, we've had 38 business cycles since the end of World War II, and they all kind of follow a classic pattern. So the economy gets stronger and it gets stronger, and things get a little hot, labor markets get tight, capacity utilization gets tight, inflation picks up, and the Fed says, okay, time to raise rates, and they do, and they're usually behind the curve, and they raise them again, and then finally the economy cools off, and things slow down, unemployment goes up, inflation goes down, capacity utilization drops, and then things look kind of bad. We're in a recession. The Fed says, okay, time to cut rates, and then they cut them, and you go up again. And so it's like a sine wave, up and down, up and down. That's a normal business and credit cycle. What's different this time is that we're not in a normal cyclical recovery. We're in a growth depression. When you get 2% growth for 7 years, that's a growth depression. That's not a normal recovery, but it's still a recovery. It may be weak. It may be well below potential. It may be depressionary in that sense, but it's still a recovery, and you're supposed to normalize rates in a recovery. And as I say, the time to do that was 2010, 2011. The Fed could have raised rates in baby steps with big gaps in between, and over the course of 2 years, 16 FOMC meetings, they could have got them up to 1.5, 1.75, something like that, if they had done that. And they should have done that. But if they had done that, they would be in a position to cut rates today. Just do 25 basis point cuts to keep the economy going. That's a normal cyclical process. The Fed missed an entire cycle. They just skipped it because of Bernanke's experimentation. And I spoke to Ben Bernanke in Korea recently, and we talked about this. And he used the word experiment. It wasn't me. That was his word for what he was doing. It looks like a failed experiment. And so analysts have this exactly backwards. There's this sense out there. I see it everywhere, and I'm incredulous that it says, oh, gee, if you raise rates, that means the economy's strong. And you better raise them fast before the economy gets too strong, as if somehow raising rates made the economy strong. That's the exact opposite. The opposite, what's supposed to happen, what normally happens, is that the economy gets strong, and then the Fed raises rates. And the Fed doesn't lead the economy up and down. The Fed follows the economy up and down. So as the economy actually gets stronger, then at some point the Fed does have to raise rates. But there's this idea out there about, you better raise rates to make the economy strong. It doesn't make the economy strong. It actually slows the economy down. That's the whole idea. So this notion that, you better raise rates before it's too late, show me the evidence of inflation. Where is it? Show me the evidence that labor markets are tight. I understand the unemployment rate is 5.1%, but so what? Labor force participation is at an all-time low. Job creation peaked last November. It's been going down ever since, going down fairly precipitously. Labor force declined last month. Real wages are going nowhere. When you look behind the headline Happy Talk data, the labor market's showing no sign of tightness, no sign of real wage increases, no signs of inflation. In fact, inflation numbers are coming down. Economic growth is coming down. We already talked about that. So you look at every indicator, this is not an economy that's getting stronger. In fact, we are 77 months into this recovery. The average recovery since 1980, and by the way, that's a very selective period because we've had two of the longest recoveries in history, the 1980s during the Reagan years and the 1990s during the Clinton years. The average recovery since 1980 is 78 months. We are now 77 months. In other words, we're 1 month away from having an exceptionally long recovery. If you do the average since World War II, that's much shorter. That's down in the low 40s. So this is a very long recovery. If you knew nothing else, if you didn't have any data about employment, inflation, or growth, or capacity utilization, or anything, and you were just looking at the longevity of it, and I agree that that's not, dispositive, but if that's all you knew, you would say we're pretty close to a recession. So this notion that somehow raising rates means you have a strong economy is nonsense. As I say, that puts the cart before the horse. It's when you have clear signs of a strong economy, which we don't. When you have clear signs of a strong economy, that's when you raise rates. So that's completely backwards. Now, I have read, actually, there was one very honest analysis where an analyst said, I get the weak data part. The analyst was very candid about today. He said, but you ought to raise rates anyway. He said, it'll take the stock market down 25% and it will cause a recession. But you ought to do it anyway because, the danger on the other side is you're creating bubbles and, that's going to end badly. Well, I agree with that completely. I think if they do raise rates, that it will take the stock market down 25% in a hurry. That's one reason to have some gold and cash. But and it will cause a recession. If we're not in one already, it will cause a recession. But this is an outside analyst saying this. And I think the analysts did a very good job of thinking about it that way. It wasn't the happy talk of raising rates makes the economy strong. It was raising rates is going to put us in a recession, but we ought to do it anyway. It's like take your medicine, kid. Well, show me a Fed chairman or a Fed board of governors who has ever tried to pop a bubble, who has ever tried to get out in front of an economic cycle or even knew a bubble when they saw it. So while I agree with that analysis, I don't think that's how Fed governors and Fed chairs think about the problem. They're looking much more in real time. They don't see bubbles. I mean, they didn't see the bubble in 07. They didn't see the dot-com bubble. They didn't see the emerging markets bubble in 97, and they didn't see the Mexican bubble in 1994. So the Fed has demonstrated that they can't see bubbles when a bubble is ready to come up and bite them in the ankle. Why would this time be any different in that sense? So the case for raising rates is either delusional in the sense that people think magically that's going to make the economy stronger, which it doesn't, or it's candid, which is it would cause a recession, but that's actually a reason not to raise rates. So, look, anything can happen. I understand that, but we do the best we can as analysts, and that's sort of how I see it.
Well, if we could just step back for a moment from this immediately topical question of tomorrow's FOMC meeting, and I'd welcome from you a little refresher in a way, a little guidance on the underlying structures that we're consistently talking about here. What I'm thinking about is the relationship of interest rates to the strength of the dollar, and then both of those to the question of inflation and deflation. Could you give us a little kind of 2-minute seminar on that, how these three forces impact each other?
Sure, and John, you and I have spoken before, and you know that when anyone brings up the subject of interest rates and how they interact with prices, inflation, deflation, and policy, etc., I'm always very quick to make the distinction between nominal interest rates and real interest rates. And that's a very important distinction that I think is too often overlooked in the discussion. So just as a quick primer, nominal interest rates those are the rates you see. So whatever the coupon on a bond is, or whatever the yield to maturity on a bond is, whatever the bank is paying you on your deposit, whatever you're actually getting, whether it's 1/4% or 2% on a 10-year note or whatever, that's the nominal interest rate. To get to the real rate, you take the nominal interest rate and you subtract inflation. So a simple example, if the nominal interest rate is 3% and inflation is 1%, it's 3 minus 1, so the real rate is 2% or positive 2. So that's how you think about real rates. And real rates have a much more of an impact on the real economy and much more of an impact on commodity prices, including gold, than nominal rates do. And just to illustrate that, gold went from $35 an ounce in 1971 to $800 an ounce in 1980. That's a 2,000% increase in about 9 years. Well, what was happening to interest rates at the time? Well, interest rates were going to the moon. They went to 6 and 7, then 10, then 13, and 15, and ultimately short-term rates got to 20%, and 30-year bond rates got up to 15%. So interest rates were sky high, and yet the price of gold was sky high. But what that leaves out is the fact that while the nominal interest rate was going up, the real interest rate was going down because inflation was going up even faster than the nominal interest rate. So, for example, there was a time in 1980 when in 30-year bonds, the nominal interest rate was 13%. But inflation was 15%. So what's 13 minus 15? Well, at least where I went to school, that's -2. In other words, the real rate isn't even positive anymore, it's negative. To me, 13% interest rates were lower than 3% interest rates. And that sounds crazy. Like, wait a second, Jim, how can 13% interest rates be lower than 3% interest rates? Well, the answer is that nominally, of course, the 3% rate is lower. But when you do it in real space, 13 minus 15 is -2. and 3 minus 1 is positive 2. So in the first case, negative rates are minus 2, and in the second case, real rates are positive 2. So it's the real rate that kills you. It's the real rate that makes gold go down, that makes investment difficult. And when real rates are low or even negative, that tends to be associated with high inflation. It's bullish for gold, at least in nominal terms, and it encourages spending and investment. So you have to always make those distinctions. So right now, people like to say interest rates are at an all-time low. And the answer is nominal rates are close to all-time lows, but real rates are nowhere near all-time lows. If you take just the 10-year note, which I think is a good proxy, that's about 2% right now, and inflation is running around 1%, give or take. So the real rate is positive 1, which is a fairly high real rate. And that's one of the reasons deflation has the upper hand. It's one of the reasons gold prices have kind of gone sideways. And so that's an important way to think about interest rates when you're trying to sort all this out. Now, having said that, what's the impact on the dollar? Well, again, high real rates make for a strong dollar. If you look around the world and you see that interest rates are being cut, I mean, Canada, Australia, New Zealand, China, you go around the world, they're all cutting interest rates. Bank of Japan, Bank of England, or Bank of Japan's at 0. And yet you look at the U.S. and I can go out and buy a 10-year note and get a positive return, even though the nominal rate's 2 with inflation at 1, I get a positive return at positive 1. All of a sudden, the U.S., for capital allocators looking around the world, the U.S. looks like a very attractive destination for capital because the real rates are high. And so that brings capital into the U.S., which means you have to buy dollars, which makes the dollar stronger. And the dollar price of gold, in some ways, is just the reciprocal of the dollar. So a strong dollar can mean a lower dollar price for gold. A weaker dollar can mean a higher dollar price for gold. Of course, John, I like to say that gold doesn't change. An ounce of gold is just an ounce of gold. That's my constant. When someone says the dollar price of gold is going up or down, I just say, well, fine, that's a dollar problem. It's not a gold problem. A lower dollar price of gold just means a strong dollar, and that is what we're saying because of the real interest rate. So the point being, you have to, these things are all connected. The nominal rate is not dispositive. You have to look at the real rate, and you have to think about things in real space, as I said, and you also have to adjust for inflation and think about the impact.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.